Tantor Audio, a division of Recorded Books, presents The Money Illusion, Market Monetarism, the Great Recession, and the Future of Monetary Policy, by Scott Sumner. Narrated by Stephen J. Cohen. Publisher's Note: the print and ebook versions of this book include visual elements. You will hear the visuals discussed and referenced in this audiobook. Preface. During the 1930s, 1940s, and 1950s, most economists believed that the Great Depression had been caused by financial distress and that monetary policy had been expansionary but largely ineffective. In the 1960s, research by Milton, Friedman, and Schwartz convinced the profession that monetary policy during the early 1930s had actually been contractionary, and that this had been a major cause of both the Depression and the banking crisis. Further research, including some of my own, established that the monetary failure had been global in nature and linked to flaws in the international gold standard. When the Great Recession of 2008 through 2009 hit the global economy, I immediately noticed that many pundits were once again misdiagnosing the crisis in ways eerily similar to the original mistaken view of the Great Depression. By this time, I had already spent several decades studying and teaching monetary economics. My research had focused on a number of topics with particular relevance to understanding the ongoing crisis, including the Great Depression, the Japanese liquidity trap of the late 1990s, and various proposals for reforming monetary policy. This gave me a unique vantage point in terms of seeing what others had missed. In some respects, I was an unlikely contrarian, as before 2008 my views were not out of the mainstream. Indeed, for nearly a quarter-century I had been reasonably satisfied with Federal Reserve policy. After Lehman Brothers failed, however, I realized that monetary policy had suddenly become much too tight, and I began trying to convince my fellow economists of the need for a much more expansionary policy. More importantly, I tried to show that the conventional wisdom was wrong. It wasn't just that policy had drifted off course in 2008. Economists, as a profession, were thinking about the entire issue in the wrong way. In early 2009, these convictions pushed me to start a blog called The Money Illusion, a move that ended up reshaping my career. By 2010, I and several bloggers who shared a similar outlook had coalesced into a school of thought dubbed market monetarism, which focused on the need to provide stable growth in nominal gross domestic product. These writers included David Beckworth, Nick Rowe, David Glassner, Marcus Nunes, and Lars Christensen, among others. The mainstream media started paying more attention to our ideas, and people I met began asking me to recommend books with market monetarist ideas. Unfortunately, I wasn't able to cite a book that provided the sort of comprehensive treatment of market monetarism that Friedman and Schwartz had provided for the earlier versions of monetarism. One can think of Friedman and Schwartz's A Monetary History of the United States as a treatise on monetarist ideas, a revisionist explanation of the Great Depression, and a rationale for monetarist policy recommendations, all in one big book. In this book, The Money Illusion, I intend to provide a treatise on market monetarist ideas, a revisionist explanation of the Great Recession, and a defense of market monetarist policy recommendations. Lots of people have contrarian views about current events, so why should you read this alternative account of the Great Recession? The best answer I can give is to point to the surprising number of instances when recent events played out in a way that supports market monetarism. Here are just a few. When I complained in late 2008 that money was too tight, almost no one else was making that claim. Today, that view is widely held, and even former chair of the Federal Reserve Ben Bernanke admitted in his memoir that the Fed erred in not cutting rates after Lehman Brothers failed. When I suggested in early 2009 that Fed policy could be much more expansionary, most observers were skeptical. When the Fed eventually tried unconventional stimulus such as quantitative easing, even if this response was still inadequate, the United States performed much better than the Eurozone, which did not try such policies until much later. When I proposed that banks adopt negative interest rates for bank reserves in January 2009, the idea was widely viewed as impractical. Today, many important central banks have adopted negative interest rates on bank reserves. After I suggested in late 2012 that monetary offset would prevent fiscal austerity in the U.S. from having the contractionary impact that was widely predicted, prominent economists dismissed my argument. My view, though, turned out to be correct. Growth picked up in 2013. The consensus view was wrong. In early 2009, I advocated nominal GDP level targeting. In subsequent years, many of the top macroeconomists in America endorsed this policy. Christina Romer, who had been head of the Council of Economic Advisers under President Obama, cited my research as providing the logic behind nominal GDP targeting in her New York Times piece endorsing the concept. An important component of market monetarism is the idea that Fed policy should be guided by market forecasts, not by the Fed's complex mathematical models of the economy. By 2019, it was clear that Fed policy is increasingly guided by market forecasts because the Fed's internal models have proved unreliable. These examples don't prove that market monetarists are right about everything, but surely the fact that so many of our claims have become increasingly accepted among respected macroeconomists is reason enough to take the ideas seriously. I hope this book provides readers with a better understanding both of what market monetarism is all about and of why we hold such unconventional views about what went wrong during the Great Recession. This book has two primary goals. One goal is to provide an explanation of basic monetary theory and of the specific perspective called market monetarism. Fulfilling this goal occupies roughly the first half of the book, which includes some technical material at the level of undergraduate economics students. The second goal, addressed in the second half of this book, is to apply these ideas to the Great Recession, which provides an alternative narrative that I believe is superior to the conventional explanation. This narrative makes it easier to see what is distinctive about the market monetarist approach. This book is intended to be accessible to upper-level undergraduate economics students, graduate students, and interested readers with some knowledge of basic economic theory. However, this book doesn't just repackage and recycle existing theories. I present a number of new ideas and perspectives that I hope will also be of interest to professional economists. Introduction. The real problem was nominal. Tell me, the great 20th century philosopher Ludwig Wittgenstein once asked a friend, why do people always say it was natural for man to assume that the sun went around the earth rather than the earth was rotating? His friend replied, well, obviously because it just looks as though the sun is going around the earth. Wittgenstein responded, well, what would it have looked like if it had looked as though the earth was rotating? Richard Dawkins, The God Delusion. Many readers of this book will have fairly vivid memories of the financial crisis that followed the failure of the Lehman Brothers investment bank and of the Great Recession that began in 2007. Liberals' and conservatives' interpretations of these events may differ in the details, such as which public policies they blame, but both sides share a common understanding of the basic trajectory of the crisis. The bursting of a major real estate bubble helped trigger first a banking crisis and then a deep recession. Monetary policy was extraordinarily expansionary during the downturn and recovery, but it was largely ineffective at boosting the economy. I present a radically different interpretation of the Great Recession. At first, it may seem implausible, even preposterous. Yet this radical view is based almost entirely on standard macroeconomic concepts, as they were understood back in 2007. It is the mainstream of the profession which abandoned this standard model that needs to justify its new view of macroeconomics. Unfortunately, few non-economists are aware of the state of macroeconomic theory circa 2007, so you may have to initially suspend your disbelief while you examine whether an alternative view of the past decade, market monetarism, makes more sense than the mainstream view. Market monetarism developed out of the crisis of 2008, but all of its components are well-established economic principles, although the way we utilize them is novel in certain respects. In a sense, this book maps my intellectual journey, illustrating how I arrived at my current views on monetary economics, which were well established by 2007. These views have always been heavily informed by both data and theory. One without the other leads nowhere. Thus, I toggle back and forth between the major empirical findings of monetary economics and the models used to make sense out of those findings. I hope it will become clear why I espouse market monetarism rather than one of the alternative approaches to macroeconomics, such as the Keynesian, Austrian, classical, or traditional monetarist schools of thought. In the second half of the book, we return to the crisis of 2008, armed with a broad understanding of monetary economics. At that point, I'll ask you a question similar to Ludwig Wittgenstein's famous query, recounted in the epigraph. What might we expect the crisis to have looked like if the market monetarist view of reality is correct? As with the solar system, the simplest and most coherent model of the Great Recession is highly counterintuitive, and not at all what many observers thought they saw happening in 2008. The conventional view. Here is how Stanford economist Robert Hall started off a survey article in the fall 2010 issue of Journal of Economic Perspectives. The worst financial crisis in the history of the United States and many other countries started in 1929. The Great Depression followed. The second worst struck in the fall of 2008, and the Great Recession followed. Although Hall is one of my favorite macroeconomists, I believe he's wrong in this case, and wrong in a very revealing way. There was no significant financial crisis in the United States during 1929. The major financial crisis of the Great Depression occurred in 1931. Now, why is this timeline so important? Because Hall's description makes it seem as if the financial crisis in 1929 triggered the Great Depression, whereas what actually occurred was that the Great Depression led to a severe financial crisis. Debts are harder to repay when national income is falling rapidly because income provides the funds that people and businesses use to repay debts. I argue that something quite similar occurred in 2008. Admittedly, the 2008 case is more complicated than that of the Great Depression, whereas the financial system was in good shape in 1929. Financial stresses were developing well before the 2008 recession because of problems with subprime loans. Even so, the specific financial crisis that Hall is referring to in the fall of 2008 is the severe crisis post-Lehman failure that began in late September 2008 and intensified in October. Why is the timing so important? Because the Great Recession began in December 2007 and became severe after June 2008. Just as in the 1930s, a slump in the economy triggered severe financial distress. In 2008, it transformed a modest banking crisis into a major financial crisis. Unfortunately, owing to lags in the collection of data on gross domestic product, at the time no one understood that the country was already in the midst of a severe recession when Lehman failed in September. It looked as though Lehman caused the severe recession because the truly horrifying GDP data came out later in 2008 and in early 2009. Real and nominal GDP. The research firm Macroeconomic Advisors estimated monthly GDP data derived from the various data series that the U.S. government uses to construct its quarterly GDP estimates. Figure 1.1 shows what things looked like during the Great Recession. It clearly shows that the sharp drop in GDP occurred between June and December 2008. Keep that 6-month period in the back of your mind, because I will continually refer back to it. Owing to quirks in the relationship between levels and rates of change, even a quarterly data series can be very misleading. For example, real GDP, RGDP, looks pretty level in the first 3 months of 2009, but quarterly RGDP actually shows a sharp decline from the fourth quarter, even though the level of GDP in the first quarter of 2009 was not much different from that of December 2008. That's because GDP during October and November 2008 was far higher than during December. The bottom dropped out of the economy in the second half of 2008, although it wasn't known that this had happened until very late in the year. Lehman failed about halfway through this steep decline in September 2008, triggering a major global banking crisis. By December, most of the damage had been done, the Great Recession had begun, and the effects would linger for years. I'm going to argue that the housing bubble and financial crisis did not cause the Great Recession. Rather, the direct cause of the recession was a fall in nominal GDP, NGDP, and the cause of the decline in NGDP was an excessively contractionary monetary policy. In a sense, the Federal Reserve was to blame, although it is probably more accurate to say that the entire economics profession was at fault, because economists were operating with a flawed model of monetary policy. The Fed rarely strays very far from the consensus view of elite macroeconomists. Figure 1.2 shows NGDP during the same period of time as is covered in Figure 1.1. Notice the same steep decline in NGDP as in RGDP from June to December 2008. When I compare these two graphs during a lecture, I usually get several questions from the audience. Isn't this pretty much a tautology? Real and nominal GDP are quite similar. Obviously, if one declines, then the other will as well, right? In what sense is a decline in NGDP a cause of a decline in RGDP? The real question is what caused them both to decline, isn't it? I sympathize with these questions, but they are based on a fundamental misunderstanding of the relationship between real and nominal variables. Although RGDP and NGDP may sound similar, they are radically different concepts, even at an ontological level. Even many economists don't grasp this because economists are forced to use numbers to measure both aggregates and because RGDP includes many different types of objects. Thus, some sort of index number is required to make sense of the concept. Nonetheless, real and nominal GDP are radically different. Nominal GDP is the total dollar value of all goods and services produced domestically in a given period of time. Real GDP is nominal GDP adjusted for changes in the price level to factor out the effects of inflation. If you want to picture NGDP, you might visualize a huge pile of dollar bills, a monetary concept. If you want to picture RGDP, you might imagine thousands of factories, shopping malls, office buildings, and homes, and of course, millions of workers providing services. Figure 1.3 shows a Zimbabwe $100 trillion bill. Because of hyperinflation caused by the printing of many such bills, in 2008, Zimbabwe's NGDP soared higher at an astronomical rate. In contrast, Zimbabwe's RGDP is a physical concept. In 2008, its RGDP took the form of abandoned farms and shuttered factories, thanks to inept government policies that punished wealth creators. Real GDP plunged as Zimbabwe fell into depression, while NGDP soared higher at the fastest rate in the world. In the United States, RGDP and NGDP are more closely correlated, but even in the United States, NGDP growth rates soared to double-digit levels in the 1970s, even as our GDP growth was about 3%, lower than during the 1960s. There's no way around it. Our GDP and NGDP are very different concepts. And yet, over shorter periods of time, NGDP and RGDP are indeed highly correlated in the U.S., although not for the reasons many assume. One of the basic goals of this book, and in some respects the key to macroeconomics, is to understand why NGDP and RGDP are highly correlated in some cases and not at all correlated in others. When we finally figure this out, we'll see that a policy that prevented NGDP from falling in 2008 would most likely also have prevented RGDP from falling, or at least greatly moderated the decline. A mild recession might have been inevitable, but the slump that occurred was far deeper than necessary. False assumptions about the stance of monetary policy. Let's say that the decline in NGDP was the proximate cause of the decline in RGDP. Later I'll explain exactly how and why these variables are related in the short run. That still leaves open the question of how I can claim that the Fed is to blame for the Great Recession. After all, everyone knows that monetary policy was extremely expansionary during 2008. The Fed cut interest rates sharply to near zero levels by the end of the year. It also pumped lots of money into the economy. As we will see, however, what everyone knows just isn't so. This is not the first time that economists have confused low interest rates with easy money. The same mistake was made during the 1930s. Not until the publication in the 1960s of the famous A Monetary History of the United States by Milton, Friedman, and Anna Schwartz did economists come to realize that monetary policy was actually quite contractionary or tight during the 1930s, despite near-zero interest rates. Today, even Ben Bernanke accepts Friedman and Schwartz's claim that the Fed was to blame for the Great Depression. Unfortunately, many economists have continued to judge the stance of monetary policy by looking at interest rates. In December 1997, Friedman expressed dismay that many were forgetting the lessons of monetary history. Interest rates in Japan had fallen to close to zero because of deflationary monetary policies, yet many pundits wrongly assumed that Japan had an easy money policy, despite a falling price level. Friedman wrote in the Wall Street Journal, "Low interest rates are generally a sign that money has been tight, as in Japan. High interest rates, that money has been easy. After the U.S. experience during the Great Depression and after inflation and rising interest rates in the 1970s, and disinflation and falling interest rates in the 1980s, I thought the fallacy of identifying tight money with high interest rates and easy money with low interest rates was dead. Apparently old fallacies never die." Here Friedman is referring to the tendency of interest rates to follow inflation. A tight money policy produces low inflation, which leads to low interest rates, and easy money leads to high inflation, which leads to a high interest rate. Although Milton Friedman was perhaps the greatest monetary economist of the 20th century, he was also a monetarist with some unconventional views. Maybe he was wrong about the policy stance in Japan. Perhaps Japan did have easy money, but Friedman isn't the only economist to note that low interest rates don't mean easy money. Consider these three key lessons for students from the best-selling monetary policy textbook in 2007. It is dangerous always to associate the easing or the tightening of monetary policy with a fall or a rise in short-term nominal interest rates. Other asset prices, besides those on short-term debt instruments, contain important information about the stance of monetary policy because they are important elements in various monetary policy transmission mechanisms. Monetary policy can be highly effective in reviving a weak economy, even if short-term rates are already near zero. These points were written by Friedrich Mishkin, a highly respected New Keynesian economist who served on the Federal Reserve Board with Ben Bernanke. As an academic, Bernanke also argued that monetary policy has an almost unlimited ability to stimulate the economy when interest rates are stuck at zero. I had been using Michigan's textbook to teach for a quarter century before 2008. I believed these three ideas were extremely important, and I always emphasized them in class. Consider my surprise, then, when I looked around in late 2008 and found that few of my fellow economists believed in these assertions. Most economists seem to think that low interest rates do represent easy money. Most economists also seem to believe that monetary policy is not highly effective when interest rates are close to zero. This discovery led me to devote my career to trying to change the conventional wisdom back to the ideas in Michigan's textbook. In this book, I explain why I stuck with the textbook version of monetary economics in 2008 and not the view that caught on with most pundits, that monetary policy became ineffective after rates hit zero in December 2008, if not earlier. Michigan was right when he claimed that monetary policy remains highly effective at near zero interest rates. How did asset markets move in late 2008? Recall that Michigan claimed that the stance of monetary policy should be measured not by the level of interest rates, but by movements in other asset prices. So let's do that, focusing on the key 6-month period in late 2008. When I point out to other economists that nominal interest rates are not a good indicator of the stance of monetary policy, they often accept my claim but suggest that the real interest rate is a good indicator. So let's look at the real interest rates on 5-year Treasury bonds from July to November 2008, figure 1.4. The graph shows a stunning increase in real interest rates, especially for such a short period of time. Yet, few of the economists I have talked to are even aware that real interest rates rose from less than 1% to more than 4% in the teeth of the financial crisis. Why would the Fed allow this to happen? In fact, the economists who point to the real interest rate are wrong. It's not a good indicator of the stance of monetary policy, for the same basic reason that nominal interest rates are unreliable. Just as nominal interest rates can be distorted by changes in expected inflation, the real interest rate can be distorted by changes in real output. Ironically, many of the economists who say we should look at the real interest rate seem unaware that this indicator suggests that monetary policy was highly contractionary in late 2008. Another popular asset price is the exchange rate, which measures the value of the dollar in terms of foreign currencies. Once again, it's not always a reliable indicator of the stance of monetary policy, but to the extent that it is useful, it was signaling extremely tight money in late 2008. Indeed, the foreign exchange value of the dollar soared by about 15% in trade-weighted terms in late 2008, as shown in figure 1.5. Interestingly, currencies almost always depreciate sharply during a severe financial crisis. Dozens of examples prove this, from Thailand to Mexico to Russia to Iceland. The rare examples when a currency appreciated during a financial crisis, for example, the U.S. in 1931 through 1932, Japan in the early 1990s, Argentina in 1998 through 2001, are cases that we now know involved excessively contractionary monetary policy. Other asset markets showed the same pattern of sharp decline in late 2008. Stock prices crashed in late 2008. Commodity prices fell by more than 50% in late 2008. Commercial real estate prices started falling sharply about the same time as NGDP, long after the subprime lending bubble burst. Residential real estate prices in the heartland, for example Texas, had been stable during the 2006 through 2008 subprime crash and started falling in late 2008, along with NGDP. Spreads in Treasury inflation-protected securities, or TIPS, in other words, inflation expectations in the bond market, fell sharply. So if economists are to take seriously what we've been teaching our students for years, then it seems that all the other asset prices Michigan referred to were flashing warning signs in 2008 that money was far too tight. Of course, Not everyone agrees with Michigan's way of characterizing the stance of monetary policy. I prefer looking at NGDP growth, as does Ben Bernanke. The imperfect reliability of money growth as an indicator of monetary policy is unfortunate, because we don't really have anything
Sample complete. Ready to continue?